Hi everybody, this is Dennis Wilbur, founder of Active Trend Trading. Did you know that option traders sometimes get their face ripped off because they don't know how to handle volatility that comes along with a market correction? This video is going to show you how to handle the volatility, simple steps you can take to make sure that you don't get your face ripped off. So please take a look at this video from the beginning to the end. And also, if you're not a subscriber to the Active Trend Trading's YouTube channel, Market Tech Talk, please hit the subscribe button down below. It's right down there. And the bell. And then fill out and let them notify you when we post new content. I hope you enjoy this. Also, watch it to the end. I'll show you how you can connect up with and get our free watch list every week. Aloha. God bless. Hey everybody, this is Dennis. It is the 11th of March 2020, and if you, unless you've been asleep for the last few days, you know that the market is in a major correction, which may even stem into going into bear market territory. Let's get with the presentation that we're doing today. This is one of our trading tips that we do with Active Trend Trading and post to our YouTube channel, Market Tech Talk. And just a reminder, as I said in the introduction, if you're not a member or subscriber to Market Tech Talk, just hit the subscribe button and then the little bell, and then just let them know you want updates when we update content, which is multiple times every week, where we basically share some of the best trading tips available for those who want to learn how to trade stocks and options. Let's see. And there's that handsome guy. Hey, how you doing, everybody? As we say, hey, trading tip, don't let volatility rip your face off. If you're an option trader, if you're a new option trader, just beginning out, I remember when I was a new option trader, I didn't know anything about volatility. I didn't know that the value of the premium on an option could just basically be way overblown and overvalued because of something called volatility. Of course, that was, oh gosh, too long ago, probably over 20 years ago that I was learning how to trade options. And but volatility, when the markets start to correct like they are right now, tends to peak. This presentation is going to give you an insight into what's going on with that. Also, will basically provide a solution to offset the volatility that you see in the marketplace, because when volatility is high, you want to be real careful, and you're going to see why in just a couple of minutes here. Of course, just remember the disclaimer remains the same. We do what we do for training purposes so that you can hopefully profit from that, and so we can comply or meet our objective, which is to help people to clarify, simplify their trading processes so that they can multiply their profits and minimize their risk. So basic guidelines: understand when to be a buyer in the buyer of options and when to be a seller. The basic guidelines are: when the volatility is high, be a seller of premium. Now there's a couple of caveats we'll go through on that and cover this. When the volatility is low, I want to be a buyer of premium. Lastly, to lower the effects of volatility, I can do things like do vertical spreads, or some kind of where I'm doing offsetting trades. And we'll show you an example of that, how much it does really, really help if you know how to trade spreads. Spreads is a secondary level option trading strategy that is, if you're doing vertical spreads, it's very similar to doing a covered call type thing. And if you want to learn more about that, you can, of course, become a premium active trend trader. So lower the effect of volatility by using shorter holding periods. In other words, if you choose to, let's say, buy a call in a high volatility environment, well, plan your holding that you're only going to hold it for like a day are 2 days. No, but we're not looking at holding on for weeks, and we'll see why here shortly. So high volatility, be a seller premium. So in order to to check to find out how high the volatility is, I want to be looking at one. I want to check the VIX. The VIX is a measure of volatility for the S&P. I also want to check the IV. Now that is not the thing that hooks to your arm that has a little drip going to it when you're in the hospital. This is called implied volatility. It shows up on the individual option chains for whatever entity you are in fact trading. We'll show you an example of that here shortly. So volatility on indexes is determined by many factors and reflected in if it's in the S&P VIX, and if it's on the NASDAQ, there is the indicator VXN. These in themselves are also trade vehicles. Some people literally just trade the VIX and they trade the VXN. And that is one way. They just know the ins and outs of these particular indicators so well. And it does, in fact, trade like an ETF. So I want to answer the question, are these above the average value? If the answer to that is yes, then I want to look to be selling premium or doing spreads to protect myself from basically the crunch and volatility that can happen. So I can also use what I'm about to show you guys to basically reveal potential market bottoms or timing for. They get you close to where things should start turning around, except if you were in really extremes. So here's an example. This is VNX. This is a monthly chart going back to the year 2000. And as you can see, it shows the time when the VIX was high due to the dot-com bubble. And then 2008, which was, some of you may have been trading in 2008 time frame, it got really high again. And the high points on the VIX actually highlight or give a generalized location date-wise for when the market bottomed and then rallied higher. As you can see, and so let's see what it measures volatility on the NASDAQ. For an index that is close to equilibrium, the value is about 18. So where is that 18 value? As you can see there on the charts, let me get this. 18 is about in here. So if the value of that is around 18, oftentimes the options that you'll be trading on either stocks that trade on the NASDAQ and or if you wanted to be trading the Qs, you're going to be about fair value on your options. What else do we have going on here? So secondly, extremes on either side can be predictive of upcoming change of character in the index. Now, when it gets down to its lows, which as you can see here, going back to 2007 and 2008, the lows were at about 10. When those lows were hit, typically the markets actually had hit a peak and then would basically, and I won't say that they would roll over and die from there, but what they would do is basically that was kind of like the ceiling for a while until the price action worked off that ceiling and went above it. But it gave us an idea of when things started to fall. So let's see. Note the past highs. 2001, 99.35. That was an extreme. 2008, 86.52. And then from 2010 to the present, we've been in a range, or the highs have been up at about 45 to 55 on the VNX, or VNX. Note that current conditions are, this is where we are right here, current conditions are above the $45. So are we coming close to hitting a market bottom that we could rebound from? the market right now is down. Years from now, when we look at the charts of 2020, you will see the big sell-off that's taken place. We will have no idea why there was a big sell-off, but we will know that something impacted the market. We won't know that it was the coronavirus and just some of the frantic selling that went on. Because of that, all we'll see is, the volatility expanded as the market fell, and we had a significant sell-off in the market, which is continuing to go on as I'm recording this during market hours. And yeah, things are, down. Oh gosh, I'm going to give you an update. The Dow for the day is down 1,200 points, which basically erases all the gain that it had yesterday. So now, the volatility may in fact launch back on up here and come up here towards these other levels. If it does that, then probably the index and the markets themselves is going to also fall. So that's it for V and X. And then VIX. VIX is the one, the VIX, Volatility Index for the S&P. This is the one that the majority of people talk about. They said, oh, the VIX is high, the VIX is low. And as you can see, going back again to 2000, it's operated in a range between $10 and 40, 10 units, if you will, up to about 48 or 50. With some past peaks. We are currently at a peak. But is this peak going to go even higher than what it is right now? So for equilibrium, we want to be at about, it's about 18. It's kind of interesting that both VIX and the V and X are kind of, populate the same ranges. Okay, extremes on either side can be predictive of upcoming changes of character in the indexes. Note the past highs. I don't show here this on there, but it was a Black Monday on back in 1987 on an October Monday, and the market just went nuts. Had a big drop. The VIX ran all the way up to 172.79. The next highest peak was in 2008. And again, remember, this peak, and this is a monthly chart, and so during the month, it could have been gyrating in this overbought or overvalued position for a while, telling us that this is not the time to be a buyer of options. So 2008. And then 2010 to present, we've run in a range between 48 and 52 up here at the top, which is an indication that of when the market was oversold. How do we use this information? That's the other part. It's great to have the information, great to see the information, but when the volatility is high, how do we use the information that we've been provided? Well, a couple of ways. One is we have to be aware that, how do we check to see if the volatility is high? One, we check the implied volatility in the option chain. And, what bites novice option traders in the butt is buying a call option at a potential low, price low, but the option has high volatility. As prices tend to rebound, volatility tends to fall. We'll see the effect of that here shortly. As price goes up, volatility goes down, also reducing some of the option premium value. And so, oftentimes new option traders, they'll get in there and they'll start to trade and they'll say, oh man, I got in at the very low. And oftentimes they make a couple of different mistakes. One, they don't buy enough time on the option. Two, they buy an option when the volatility is really, really high. And so when the prices then start to go in their favor, the other thing that they do is they don't buy an option that's enough in the money. So that when it starts to go in their favor, the volatility falling actually counteracts any of the gain they may have had. And sometimes they can actually wind up where the underlying stock or ETF hit its target as far as a price move, but the option underneath it loses money. And so the young novice option trader at that point is kind of going, huh, what happened? So how do you know? Well, here's some examples. Let's use IWM. Here's a perfectly good time. This was a snapshot I made for another presentation that I did back at the midsection of January 2020, so it's recent information. But back in January 2020, or just a couple of months ago, the market was on its way, just continuing to make new highs, and everything was just hunky-dory, wonderful. And take a look at how high the implied volatility was for IWM. IWM is the ETF that represents the Russell 2000. As you can see, it was at 13%. That was the implied volatility. Its range, here's another thing to keep in mind, its expected range, on this was on an option that was about 2 weeks out. It was expected to move about $3 in those 2 weeks, plus or minus $2.96. It had a implied volatility of 13%. Write a note to myself here. So what happens from there? Well, let's see where things go. So again, VIX at that time was about 15%. Well, look what happens when we just roll over. Now, this is current. This is as of the 10th. And let me see if I can move that over. There we go. Yeah, we did. As you can notice, look at, the volatility has just blown up on us. The implied volatility is now up at 66% on a option that's 2 weeks out. So the expected move over those 2 weeks, because the volatility is high, has gone up from a little under $3 up to almost $12 is the expected move during that time frame. That's either a plus or a minus $12. And you can go, wow, that's impressive. But let's get into the option chain table to see how that impacts our potential to buy an option and why it's maybe not a good idea to be buying an option. VIX, when I took this snapshot again, it was on March 10th, 2020, was sitting at about 54%. So the VIX went from 13% up to 54%, and the implied volatility, it was at about 15% up to 54%. Implied volatility went from 13 to 66 on IWM. So let's take a look at how that impacts our planning for trading options. And this top table here, option table, is just looking out actually about 6 weeks to 17 April 2020. As you can see, IWM is sitting at about $129 to $130. If I were to buy a in the money with a 0.6 delta call contract, I'd be looking at the 125s. So I can buy the 0.61 delta April 17th at $10.28 right there. And in my analysis, I expect it between now and the 17th of April to run at least $10. So I can go to the theoretical value tool that's on the Thinkorswim platform, and I can plug into here and say, okay, let's just take it out a week from now. So I did this on 310. what's it going to look like on Friday 3/20, about a week and a half from now, where the price has gone up $5. In other words, I'm halfway to meeting my goal of $10. Now, I may look at this and go, okay, well, in a week, IWM goes up $5, and my option is worth, well, look at that, $12.61. So I've gained about, $2.30 on the trade. I'm going, hey, that's really fantastic. Or is it? There's where the question comes in. Or is it? If IWM starts to rally, here's a more likely scenario. Again, everything stays the same. We get in at $10.28. In a week, IWM goes up $5. However, what also happens is implied volatility on this option chain and this expiration date also drops, and so it implied volatility can drop very quickly, as the VIX can drop very quickly and the VNX can drop very quickly. 20% drop on that is sometimes what it does in a day, especially when it's at an elevated level. So let's say it drops 20% between now over the next 7-8 days. So my price of my the underlying ETF IWM goes up $5. However, my volatility drops 20%. What does that do to my value? Well, as you can see, my option is worth how much? $10.45. And so in a week's time, even though prices went in my direction, $5, the value that I made a whopping a little bit 23 cents. So, but is there a better way? That's one of the questions we always want to ask. Is there a way to offset this aspect? Now, if the price of the option, if the price of IWM, the price action continues to go up, then eventually, if it gets high enough, the delta will in fact get to a place where it will start gaining money again. But you got to remember, okay, if I'm sitting at 129 and I buy the 125s at $10, well, the value of my option at expiration date has to be sitting at least 135 just to pay for the option. See what I'm saying? So a lot of times when people look to buy their options, they'll say, hey, well, that's just too much value or it's too expensive. It doesn't make sense. It's not a prudent way to buy this. But I still want to participate in a potential upside trade. So the way you can work this is work a spread that will cancel out much of the effect of implied volatility. So here's this is basically the same time frame. I'm looking at 5 to 6 weeks. And as you can see, I'm looking at, what am I looking at? And let's see what the impact of volatility is. Here's a spread, and I want to buy, and I'll show you what I want to buy here. And as I highlight here, I want to do a debit spread. When I do a debit spread, I buy, and this is a debit call spread, I buy the lower strike price and I sell the upper strike price. And so I go up here to 130. Here's the 130. And as you can see, I can buy the 130 for $7.72. Now, the value is still elevated, right? Because it's still elevated simply because the implied volatility is still quite high. But then I take and I say, okay, I want to participate, and I recognize I'll put a cap on how much I can make, but I'm going to reduce the level of my my exposure to volatility by then selling a higher valued option, which in this case the strike price is 135. I could sell that for the estimator says I could sell that for $5.04. So you can see 772 minus 504 means I will pay $2.68. My upside potential gain would be a total of $5, but I'd have to take $5 less the 268, so that gives me about $2.32 of potential gain. So I'm saying, okay, that's okay, and then I basically would size this appropriately to meet my own money management rules for my trading. So again, this is with the high volatility. What happened, and so here's how it impacts us. And I just did an estimate here, and I said, let's take the same period, same date, 310, but let's reduce the volatility on it just to get an idea of how much the same trade would have cost us with a reduction if the volatility was where it normally is. And as you can see on that, now I've got a couple of different things. One is I'm going to buy the same. I'm going to buy the 130. I'm going to sell the 135. But as you can see, is now the volatility has gone down. The value of the options at those at those particular strike prices has also dropped. My 130 is down at $4.40. My the one I'm going to sell, the 135, is at 186. Now I'm buying or paying $2.54 for the same position. If you'll remember on the previous, the value was about $4 or $5 or $6 difference due to volatility that I could potentially lose if volatility crunches. So in this case, I have offset much of the volatility. I still get to participate, and the extra volatility, yeah, it's 14 cents. 14 cents rather than that larger number, or basically get into the trade and not have any gain whatsoever. With this, if the price action goes, and again, remember what my projected move was. Well, my projected move was $10, and will take me completely through this level, 130 to 135, to the upside, and so. So this will be worth $5 at expiration. Now, of course, I may be looking to close it early, and I won't get into the nuts and bolts on that. We'll save that for another video. But as you can see, doing a spread, high volatility, offsets a huge amount of the extra cost of options due to the implied volatility. So, hey, for the Honolulu IBD meetup, thanks for letting me show you this presentation last night. And next month, we'll be talking about spreads, debit or credit, which is best, which is the best type of strategy. And if you are in Hawaii and want to hook up with a good bunch of traders, look up the Honolulu IBD meetup. You can also get in touch with me. I'll tell you all about it. And then, hey, if you're a busy person, you don't want to have to go searching for all your stocks. Here's an excellent thing that I provide on a weekly basis. I basically do a Power Rank Elite watch list where I rip out all the stocks from 13 of the premium IBD watch list. I convert it over to an elite list that usually punches out about 14 to 20 stocks every week. And then on top of that, for members who want to be top 5 members, I place them in a go, no-go table like this. every week, and it specifically gives you the points of entry for doing particular trades. And as you can see, let me hide myself really quick. There we go. As you can see, it's worth about $260 a month, and we normally charge $79.99 for it. However, since you're joining me for this webinar, be my guest and join us for $19.99 a month, or you can get even a better deal if you go for a full year's membership. And again, every weekend, usually on either Saturday or Sunday, you will get this go, no-go table updated with new stocks, and actually they're the absolute best growth stocks available that were been highlighted on IBD. So subscribe today, save 75%. Oh, there's where you find it. Oh, hey, what's this guy doing here? Hey, if you, please take a look at the little icon here. It'll show you, one, how to connect up and get your free watch list from Active Trend Trading. And also, hey, take a look at the next video that's coming up. And little icons will be coming up to show you that. Thanks for joining us today. If you have any comments, again, please leave the comments down below. And again, if you're not subscribed, please hit the subscribe button. Aloha. God bless everybody.